Hi folks, Greg Wright here. I'm glad to have you back for video number 2 of our series on how to build your own home right. So today's topic is going to be financing. So as you get into the project and get started on building your own home, the first thing you're going to want to do is you're going to want to go down and talk to a lender, see about getting pre-qualified for a construction loan. Now, there's different ways you can finance a build. You can have a family member that's willing to loan you money that you may be able to get, that you would just refinance the home or finance it with a conventional lender when you're done building and pay them back. And if they're wanting on some interest on it, that's normal as well. Or you could have a family member gift you some property. But any way that you get the property, whether you have to buy it as part of the project, as part of the package of your construction loan, that is perfectly normal as well. So there's different ways to tie the land into that, but you want to make sure that you have an idea before you even start, and it should be a very accurate one, whether you're going to be able to get enough financing to actually do the project. So that being said, let's get into the different methods of financing. So one method that I don't highly recommend it, but it's available if you need it, and for some reason, maybe your credit score is not high enough to get a conventional loan, and you know within a couple years that you're going to be able to get that worked out where you can actually, refinance that house out of what's called a hard money loan. So these loans are generally shorter term, anywhere from 9 months to 2 years. They give you time to build the house, time to get your finances in order, but they're not a long-term loan by any stretch of the imagination. And one good thing about them is some of them do not have a minimum credit score. A lot of your regular construction financing, you're gonna have to have good credit before they loan you on a construction loan. They are going to charge you higher interest rates on a hard money loan. It's just a riskier loan because of your credit rating or whatever, the lender is at more risk. So they're going to charge you higher interest rates, and they're going to charge you probably higher points. So a point is some of them are a loan origination fee, which is $1,500. I'm just going to give it a guesstimation there. And then on top of that, they may add another 2 or 3 points, 4 points on top of that. And a point is 1% of the loan value. So your loan fees to get a hard money loan are generally higher than a conventional loan as well. So again, it's an avenue that you may have to do, but it's not necessarily the best way to go. So the best way by far is a standard residential construction loan. Now here in our area in Idaho, we've got lenders that do a lot of lending for construction and for builders, and they also have a really good homeowner package as well. So on that particular package, you're gonna have to come up with 35% down. You're going to, and which is higher than and obviously as a conventional loan. If you were to go buy a house, you could still get FHA approved loans for 3%, 5%, 10%. They're kind of all over the board. But when you start getting into construction, then it changes things. So you will have, in this particular lender, and again, you need to go to a lender in your area so that they can give you the guidelines for where you're at. They vary. It could be different all over the country depending on where you live. But here, so I'm just going to use where I'm familiar with in my area, and then you're going to have to do your research wherever you're at. So again, 35% down payment. They're also going to include a 10% contingency. So when you put together your loan package, they're going to require you to do a full budget on your home, and there's other documents that are going to require a description of materials list where you have to itemize all your appliance manufacturers and model numbers and things of that nature, plumbing fixtures that you're planning on using that house, so that they know what exactly is going in their house, so that they can do the what they call a table appraisal on that to make sure the loan to value is correct. But they're going to add 10%, and it's called a contingency that goes on the top of your budget. And that's there for good reason. I've used them myself because nobody, even as a general contractor, nobody's that good where you're gonna hit to the penny what it's gonna cost you to build everything in that house. So that contingency gives you a 10% extra amount of dollars to use in case price increases and materials go up, labor of a sub goes up, things of that nature, that you've got enough money built into that loan to pay those things off. You don't have to use it. At the end of the loan on a construction loan, we'll get into that in a second, but there are construction loans are to close loans. But as for right now, let's just stay with what the contingency is. So it's basically a cushion. It's to make sure that you've got enough money to go in to finish that project. So they are going to require that your credit score is pretty high. A 720 is what the minimum that they require for the lender that I'm referring to. But again, so if you're under that and you can't get their financing, that's where maybe the hard money goes. And then whatever your reasons are where you can't get to 720, maybe that year or two gives you a chance to get to that. They're also, the loan is only good if it's your primary resident. They're not looking at investment properties. The loan is only for your personal home. And they also have a maximum of 15 acres. So lenders don't particularly like large parcels, mini ranches, farms. There's the market for that is a little different than it is for a residential home, and they don't normally like to get involved with that. So again, their maximum acreage is 15. So just remember that. So the term of these loans are generally 9 to 18 months for a build. And that would be on the there's two, well, let's divert back to this 1 and 2 close. So if you're doing a 1 close loan, that means you do your construction finances tied to that. And when you're done building, then you automatically roll into your takeout financing, and that just stays all within the same loan basically. This particular lender is what they have, a 2 close loan. So your construction part is based on, you have to qualify for that, and then that can be anywhere from 9 to 18 months. And then when you're done with that, then you go into the second loan, which is your takeout loan, and you basically have to get another loan. But the same lender will work with you through that, and you should end up be able to stay right with the same lender and just go into a carryout loan. So that's basically what a 1 or 2 time close is. So, and you generally get 12 months, and then if your value of your home is $720,000 or so, they might give you that extra 6 months to get it out to 18 to get it built, because generally your house is probably larger, maybe a little more intricate, takes a little longer to build, and they're willing to go ahead and do that. So, and they're also going to require a letter from you stating your experience and whether you have the ability to actually build this house, because they don't want to have to go in and find somebody to finish your house, right? So you need to, they're going to want a letter from that, and you're going to have to prove to them that you have the ability to build this house. And also another thing that we need to talk about is builder's risk insurance. That is going to be a part of any build that you do. The lender is going to require that you have insurance on that. And builder's risk is basically covers any liability issues you might have. If a subcontractor gets hurt on the job, they should have their own insurance. You need to make sure if you hire a subcontractor that they have their own insurance and license. But if you're doing the work and one of your friends comes over, slips and falls and breaks a leg on your property, you need to make sure that you're covered for any kind of liability in that sense. And also for fire, flood, or anything like that can happen. So those items are covered under that builder's risk insurance. And that is generally just an extra expense that you're gonna have to put in on your line item. When you do your budget, you're gonna have to budget in for insurances on those. So, but that's about it. It's pretty simple. There's a little bit of work to get all your project data together to give to the bank. And it takes a little bit of time to put all that together. But once you get that done, it gets your loan going. And then you're off to what's starting to be the fun part is now you get to go find your piece of ground that you want. and start working on your plans. And that's where in my opinion, that's where it starts getting fun. And then you can kind of design your own home, do all the stuff that you want to do with the property. And that's what's fun about it. So if you enjoyed what you saw today, please hit the subscribe button. I'd really appreciate it. And we look forward to seeing you on our next video number 3, which we're going to be talking about how to find that perfect piece of land for your build. So again, thanks for watching, and we'll see you on the next one.